Hello and welcome to another episode of the Real Estate Investing Club. I'm your host, Gabe Peterson, and this is the place investors go to gain actionable advice, learn about current market trends, and hear war stories from other professional investors out there in the field today. Before we get started, I have two quick housekeeping items for you. First, if you like this episode, we would very much appreciate a like, subscribe, and share. It is the best way to support the show and keep it running far into the future. Second, if you're a new investor looking to get started in real estate or an experienced investor looking to take your investing to the next level, I've created an ebook just for you that will cover how to find deals that are actually deals, how to finance those deals with little to no money down, and how to exit those deals for maximum value. On top of that, I throw in an insane amount of free bonuses that you'll have access to once you buy the ebook. All I charge is our admin costs to keep this show running. So if you're serious about real estate investing and want to create both active and passive income as an investor, head on over to the website at therealestateinvestingclub.com and click on the button that says get the ebook in the upper right-hand corner to grab yourself a copy. With that said, let's dive right in. Today we have a very special guest with us, ready to drop some investor knowledge on you. So buckle up, grab your pen and paper, and enjoy the ride. All right, we are live. Today we have Jordan Linkow from Denver. Jordy is the president of Nectar Equities out there in the beautiful state of Colorado. Jordy, thank you very much for joining the show today. How you doing?
I'm doing great, Gabe. Thanks so much for having me.
Absolutely. To get us started, why don't you tell everybody, who you are, where you're from, and how you got started in real estate in the first place?
Absolutely. Happy to. As Gabe mentioned, my name is Jordan Linkow. I am the president of a family office-based real estate private equity group based out of Denver, Colorado. I am a fourth-generation native of Denver, so have been here the whole time. Got my education in finance from the University of Colorado, after which I started working in real estate private equity in a suburb of Denver called Cherry Creek for a group called the Bro Group. We focused on commercial real estate, railroads, and energy. Worked there for 3 years when I got recruited by one of my principals and partners, Marty Herzog, to come and run business development for his organization, J. Herzog and Sons. We partnered up with another high net worth family and started running due diligence on deals between the two of those families and have been doing so ever since. That was about 10 years ago. We formalized Nectar Equities 7 years ago. And that's where we sit today.
Awesome. I love it. So you are a native Coloradan, or however you say that. Coloradoan. It's fourth generation. That's great. So I'm sure somewhere down in the history, you guys came over on the wagons and settled. That's awesome.
Yeah.
You went to U of Colorado, and you got started in what type of real estate did you guys originally start in? Are you guys multifamily, single family? What are you doing out there?
As it relates to Nectar Equities, Gabe, or are you asking?
Well, actually, we can. Yep, jumping into Nectar Equities in 1 second. But when you first got started,
Sure.
What were you guys?
Sure. No, good question. When I first got started, we were on the commercial side. We were primarily investing in office and industrial. Then when I transitioned into Marty's organization, I was working on the flip side of the coin, doing a lot of retail and hospitality. And then when Nectar Equities was formalized, we really are product type agnostic. We focus on anything where we can create value. We don't do a lot of office. We try and stay away from things that are overly capital intensive from a leasing commission or a tenant improvement perspective. We're really in the business of preserving capital. So we're less risk averse than I think most investors out there. And because we're investing literally our own money 100% of the time, we believe that we're really always aligned with LPs if we were ever to take any in.
Awesome. I love it. So originally you got started office, industrial, retail, and hospitality. That's a big swatch of commercial. I love it.
Yes, sir. Yeah, we're pretty full service.
That's great. That's great. But since then, I mean, you moved on to Nectar. What do you guys do now? You said you do value add. You stay away from office. Do you? Is there anything else? It sounds like you pretty much go wherever you find really good value that can be added to any
Sure.
property.
Yeah. I mean, I think that everything that we do is a function of where industry stands at any given point in time. So, for example, when we started this 7 years ago, we were buying assets out of the last downturn. A lot of those were land deals that we were able to buy out of foreclosure.
Oh, nice.
Happy to give some examples. We purchased an opportunity in Longmont, Colorado, which is a suburb of Boulder adjacent, we'll call it, from First Citizens Bank out of California. It was a 12-acre parcel of land that was zoned business light industrial, surrounded on all sides by residential assets. So even though the comp plan said it should be business light industrial, we knew over time it had to change. We went in, we worked with the city for about a year, were able to get that rezoned to mixed density residential, and then ultimately sold that asset to a developer here in town 3 years later. That's an example of what we're doing out of the downturn. We bought some broken condo development ground from a developer who was dealing with some construction defect litigation. Happy to go into that opportunity if it's of interest. Then as we moved kind of past the downturn, we started doing some retail deals. We did some single tenant triple net deals. And more recently, we've been focused on industrial and flex industrial along with covered land plays. So happy to give examples, happy to talk about really any of those asset classes that we play in, Gabe.
Awesome. Yeah, no, I love it. So you've been in land deals. It sounds like you're doing some triple net as well. And this is the recent stuff that you've done. Let's go into land first. That seems to be a big topic with people who are in the more high value areas, especially here in Seattle. Land is a big thing. So how do you? I mean, you've already kind of touched on how you found that one deal. What were you looking for? It sounds like you found a plot of land that was surrounded by residential. It was zoned industrial, and so you knew it had to change. You knew there was some value to add there. So how did you go about finding that deal, and when you're investing in land, what is it that you're looking for? What are the aspects that you're looking for there?
Sure, absolutely. Like I said to begin, we're very risk averse. So when we're going into land, we're always going to do so on an all cash basis. We never want to have debt on something that doesn't have income. In regards to what we're looking for multiple economic drivers. We're looking for a way or an issue that we can resolve to create value. Colorado and Washington are very similar. They're both right to work states. They both have issues with water. Things of that nature. So we're looking for value add components that we can find in our due diligence where we're able to buy assets right and inherently bake in good returns really before we get started.
Got you. I love it. Yeah. So I like one thing you said. You said you don't put debt on a property that does not cash flow or it doesn't generate revenue. It only makes sense.
I'd go so far as to say, Gabe, that almost every piece of dirt that we've acquired has become an opportunity because someone else made that mistake before us. And we've been happy to come in and clean up what remains.
Yeah, absolutely. I mean, some plots of land out here in Seattle, they'll go for $500,000, $1 million. And if you buy that and then you can't find a developer to buy it from you, that's a hefty carry cost that you're going to have to be dealing with for as long as you have the property. So it would be much preferable just to pay property taxes than it would be to pay that debt note.
No,
for sure.
100%. And in most cases, we'll try and maintain some sort of agricultural designation from a tax perspective just to keep that carrying cost as low as possible until such time it's right to change the zoning into something that makes more sense. But to your point and understanding that both of our markets have a lot of similarity, the first land deal that we purchased was actually a broken condo development. And we bought that from a developer. And
sorry, I'm jumping in here real quick. You said that the land deal, but it was already developed. There was a condo on it already. And so my initial question is why why did you buy it as land when it was already when it already had a development on it? Was it could you not fix up those apartments and rent them out, or what was going through your head then?
Sure, absolutely, and happy to walk you through it because it's maybe a bit complex. I'll try and make it as digestible as possible. But effectively, what had happened was the developer had started developing 2 condo communities, so multifamily, but for sale, not for rent. In one community, he had built 100 condos of 228, and in the other community, he had built 60 condos of 160. So between the two, there was 228 units still to be developed. We purchased the undeveloped portion of those communities, not the existing infrastructure or the existing improvements. The issue was in Colorado, we have something called construction defect litigation, where an association can elect to sue the developer for basically any issue with the construction. And it's really problematic.
It's rough for developers and contractors for sure. I give them mad props because I would not want to be in that situation.
And so at the time, and we're talking 2013, 2014, for sale product was dead across Metro Denver. No one was willing to take the risk of having these lawyers come and sue them for construction defect litigation. So the developer was in a very problematic situation because he had 2 lawsuits with associations that certainly weren't going to let him continue building out the remainderment of those properties. And we were able to come in and buy out his remaining positions for basically the cost for the face value of his debt, which was $1.25 million. In the process of our due diligence, we uncovered just shy of $800,000 of water credits that came with the property. So we were effectively able to buy down our basis to under $2,000 a door in the process. Where the hair on the deal was, Gabe, was figuring out a way to convince the respective associations to allow us to build out the remainderment of the project as traditional multifamily, meaning for rent instead of for sale. And that's a tough situation to ask a homeowner to effectively turn their community, their condo community, into a rental project. And so we worked with both respective associations to create reciprocal easement and cost sharing agreements, meaning we came up with an agreement that allowed us to share in the common elements of the community, the clubhouse, the mailboxes, the garages, the streets, etc. But to be able to keep our development separate from theirs, we didn't want to be associated with the problems of the previous construction. And the sell point to them ultimately was, first of all, you have an issue because your property is mired in litigation, but you're living in an undeveloped community. In addition to that, the community was already more than 50% non-owner occupied. And so I think it was just educating them that even though they own condos, they really were already living in a rental community. And by being able to finish the community, it created more value for them long term. So we went through a lot of work, being able to work with the municipalities and the respective homeowners to be able to develop that property as we just discussed. And then, as luck would have it, someone took the risk and ended up developing them as condos at the end of the day. But like I said, our net basis in that deal was probably around $400,000 if you net out the water credits that we identified. And then we sold that property 3 years later for just over $4.6 million.
Wow, that is a great return there. That's awesome, fantastic. I mean, there's a lot of things that jump out there. First, I guess first for people like listening and watching, they would love to get in on a deal like that, but the hard part is finding it. So how'd you guys find this deal in the first place?
Sure. I think that one of our greatest competitive advantages is our network. So I'm obviously the youngest person on the team. My 2 principals are in their 70s. They both have 40 plus years of real estate experience each. So the team as a whole has over 100 years of real estate experience combined. And one thing that you can't replicate in today's world are those relationships and the network that you build, having an entire career in real estate. So whether that's brokerage across the country, banking relationships, or even bankruptcy attorneys, putting yourself in a position where those people think to call you first is really where we derive a lot of our value on the front end.
That makes sense. And I can't tell you how many people have come on this show and said that networking is one of their the most important things that they engage in when it comes to real estate. And so building relationships, I mean, it'll just pay dividends down the road.
Couldn't agree more. And I don't mean to have such a bummer of an answer, I guess, for people who are looking to get involved. And I'm saying, well, if you can replicate 100 years of connections, then by all means, come and do what we do. But for anyone who's just getting started, I say, don't judge a book by its cover. You never know who you're going to meet. You never know when those relationships may turn into a great opportunity down the road.
For sure. I love that. So I'm going to move us off of land just for a second.
Please.
I loved everything you said so far. Let's jump into triple net. This is something I know commercial. There is talks of it being the next apocalypse, but there's also a lot of people that are really excited about investing in commercial and triple net especially. So first tell people what triple net is, and then go into kind of why you decided to jump into that type of asset or that type of deal.
Happy to. Thank you for the question. So I guess from my perspective, I would say the layman definition of single tenant triple net is where you buy a property that only has one tenant, and that tenant covers all of the expenses, all of the operating expenses, all of the insurance, all of the taxes. They basically just pay you rent, and everything else is their obligation. In terms of why we like the asset type, I think that we differentiate ourselves here.
Just jumping in real quick, and
Please.
You can only find this type of arrangement in commercial. There's no, unless you're doing in lease to own, but even then, I mean, you're still on the hook for property taxes and everything. So, so this is really specific to, for instance, like Applebee's restaurant buildings or commercial properties that are paid by a single owner. Just wanted to clarify that one real quick.
No, absolutely correct. I'm sorry that I didn't give more detail there.
Yep.
I think that when most people think of triple net or single tenant triple net, it's really almost more like a fixed income investment, Gabe. I mean, people are looking for 10, 15, 20 years where they say, I'm getting paid X%, and I know I can just clip that coupon and diversify my portfolio into real estate. I like this automotive use or this fast food restaurant. And that's, I think, how most people utilize single tenant triple net deals. For people who are familiar with 1031 exchanges, where you're taking your proceeds from a real estate sale and moving it into another real estate investment to avoid paying taxes, whether that be short-term or long-term gain, single tenant triple net is a very, very popular place that people like to go with that equity. It's a safe way to lock up money, assuming you do your due diligence correctly. Having said all that, I'm now going to tell you why we do it completely differently. We really aren't in the business of owning those type of properties for 20 years. We like to create more value on the front end. So we look really across our portfolio, but in single tenant triple net specifically, we're looking for anomaly deals. That can be a relationship between a landlord and a tenant that's become strenuous for whatever reason. It can be where a tenant has a rent to sales ratio that's out of whack and makes the profitability of their store no longer feasible. Or it could be where a large corporation is requiring a franchisee to remodel a store and they don't have the capital to do so, that being the tenant or the landlord. So we generally look to acquire assets that have, let's call it, less than 3 years remaining, where one of the problems I just described is problematic for that relationship, where we can come in and provide our expertise, resolve that issue, renew the tenant for long term, and then exit the asset. So one example, several years ago, we purchased a Taco Bell in Chandler, Arizona. For people who remember the front end of the Trump administration, and I promise this won't get political, they may remember a $2 billion deal that he was touting, I believe, for Intel, expanding their campus in Chandler, Arizona. So we were able to identify a property very close by.
Okay.
It's operated by the second largest franchisee of Taco Bells in the state. Obviously, Taco Bell is Yum brand. It's a publicly traded, very solid credit tenant. And you had an owner there who just really had diversified because of that 1031 I talked about earlier, didn't really understand real estate. The tenant wanted to redo their store. They weren't willing to invest the capital. And without getting into too much detail, or to make a long story a little bit longer, they had a lawyer in the middle that was very problematic. So we were able to come in, provide them enough of a return on the sale where the landlord felt comfortable, and then we were able to go to the franchisee. We paid 50% of their remodel, which was a $450,000 nut. So we paid $225,000.
That's how much it costs to fix up a Taco Bell, huh? $450,000.
It's a lot, but I mean, you're effectively redoing the whole building. So it's not an insubstantial capital expenditure.
Mm-hmm.
But having said that, we were able to keep their rent relatively high, just under $175,000 a year. And they gave us a 20-year term in addition to what was remaining. So to have a 21 and a half year term on a credit tenant in an A-plus location is a very abnormal exit for a traditional single tenant triple net deal. We purchased that property for just under $2.4 million. We held it just long enough to go long-term cap gains. So I believe we executed the sale 54 weeks later, and we made over $1 million on that interaction. Wow. So any chance, that's obviously an anomaly. We've got other examples that weren't as profitable, but that's kind of the name of the game of how we like to play in the single tenant triple net world.
Awesome. No, I love it. And I mean, that is, I like that you went in and it sounds like you renewed a lease, or you signed a new lease with the tenant for 10 years. And that's one of the reason that a lot of people like this type of investment, because the leases are so long.
Exactly.
You know, if you're coming from, the world of residential, then you're dealing with 1 year, 2 year leases, even 6 months.
Sure. Even month to month in some cases.
Yeah, absolutely. And
so anytime that you can get north of a 20, it's a lot of duration. And for anything, 8 years is a long time.
Absolutely. But it's also, I mean, as a landlord, it gives you peace of mind, because you can plan to the future. You have a 10-year lease that you can kind of predict. You can kind of expect this to keep going over the course of 10 years. It gives you time to plan. And so, I mean, I've never invested myself in commercial, but or at least that type of commercial, but I've heard it's a great asset to go after just because of the stability. Although the next question that I kind of wanted to ask you was, what do you see coming down the pipeline for triple net, for just commercial office space, anything commercial? Let's take multifamily, mobile home parks, all that out of the equation. When you're talking like retail, office, even industrial, what do you see coming down the pipeline in the next 5 years?
Sure, it's a great question. And it's phrased in an interesting way with the product types that you're excluding. But we were very heavily invested in retail, and based on what's been happening from a macroeconomic perspective with e-commerce, with your Googles and your Amazons of the world, retail, in our opinion, especially big box retail, enclosed malls, even strip centers to some extent, are an area where we've been moving away from. I think that with the global pandemic and what's been happening worldwide over the last 5 months, it's our opinion that an inevitability that was already occurring in that product type is just now being accelerated. I think there will be plenty of people who survive this. I think there will be a surprisingly large number of tenants that don't, whether that be through things like J. Crew and their bankruptcy and reorganization, or your smaller mom and pop tenants that just don't have the financial wherewithal to be able to withstand 6 months of no business. It's an area that's in for a lot of pain and a lot of change over the next however many years that we want to discuss. But I think that trend will certainly continue. It's just been ramped up given our current situation. To go into a little bit more detail, I think that people are currently floating on a bit of inflation because of PPP dollars and basically government assistance that's allowed people to keep people employed and to keep doors open where that's allowed for essentially the last 90 days. And as those loans start to burn off, I think we're going to see the reality come home to roost relatively quickly. So from an investment perspective, it's never the way that you want to, you never want opportunity to arise due to someone else's hardship, but there will be a lot of opportunity in select cases to buy single tenant triple nets with good tenants and good returns. There will be opportunities in our opinion to buy what I'll call community service retail that people still need, call that oil changes, transmission stores, an accountant, things of that nature, food once we're finally able to return to.
Please let that happen soon.
Yeah, I mean, certainly I'm broadcasting from my basement here. I am COVID conservative, they've told me, because my family's not trying to take a lot of risk with a newborn. But when all of that happens, there will still be segments of the market that has staying power, and I believe is still a sound real estate investment. I just think there's going to be a lot of issues where that isn't the case. Moving on to things like office, I think office is probably one of the biggest surprises given the pandemic, because so many people like myself have realized, I don't need to travel as much. I don't need to be in the office every day. A lot can happen remotely. I think larger organizations are realizing they don't need 8 floors of a building in downtown Manhattan or tech companies in California. So I think that there are going to be a lot of landlords in traditional office, especially in core cities that are going to have a lot of work on their hands to keep their assets cash flowing and occupied. I think that one benefit from that will be kind of a flight to the suburbs, and office product that hasn't traditionally been viewed as core or kind of a central business district all of a sudden becomes more valuable as people realize they want a place to go that isn't the house, but they don't need to drive 30 minutes to an hour to be in the heart of town in order to operate as things did historically. So I think that there's going to be a really interesting shift as it relates to office product. And then when we talk about industrial and flex industrial, I really think that's the largest winner of everything going on pre and post pandemic. I think that as the world moves to e-commerce and everyone expects product to be delivered to their door in 48 hours or less, to be able to have everything delivered and shipping and free returns and everything, all of that has to have a place to live. And high cubed industrial and flex industrial is where all of that happens. So in my humble opinion, I think that's the product type that I'm happiest to have in my portfolio today, and one that we'll be actively pursuing for the foreseeable future.
Awesome. Yes, industrial. And you're not the first person to say that. There's been it's been echoed across the past the past handful of guests that have come on, as they say, industrial is the next wave. So I like that, and I like that you mentioned there's flight to the suburbs. In fact, one guest even mentioned that there was they expect to see a lot of kind of WeWork of type of office. I can't remember what they call it, like office rent or rent space, or
co-working space or
co-working
whatever
space. Yeah. I personally never saw that as being a huge trend, but I can see it. I mean, now that we're in COVID and we see that, people are just staying home and working, and companies are still functioning. People are realizing they don't need to go into the office. I can see that being a thing. So I don't know, interesting times ahead for sure.
It's a very interesting time. I'm less bullish on co-working space personally. I think that the reality that we're currently living through is a great example of why that could be a big liability. But I think someone will figure out how to do it in a safe way, and there's certainly going to be a lot of displaced tenants looking for a new home. So your point is duly noted.
Perfect. Awesome. So I'm going to shift us to the end of the show here. We do like to keep this around 20 to 30 minutes. So these are quick questions just to kind of get a feel for you here. So, you've been in real estate since the beginning of time. It sounds like your family came over here, however many years ago, and they many generations have been doing the same thing. So you got a lot of experience. So going back to the Jordy who had just got started in real estate, you're green on the ears and you're just getting into it. Tell us, if you could go back to that Jordy and give him one piece of advice, what is the piece of advice you'd give him?
I would tell him two things, if you don't mind me giving two. One, we've already touched on a little bit, and that's be very open-minded. Don't judge a book by its cover. I can't emphasize how important your network can be. You never know when opportunity is going to come from the most random of places. So meet everyone that you can and stay in touch with those people as much as possible. I think that the second thing that I would tell myself, 20 years ago is it's better to be a junk dealer who's a janitor who owns the building than to pursue the shiny building on Main and Main and overpay for it. People go broke by too many good deals. So be selective and find things that actually have intrinsic value.
I like it. So network and relationships, and then be selective on the deals, because you're right. You don't want to chase the shiny objects. You want to get things that are actually cash flowing and providing an income to you. So great advice. Next one, we all get our information somewhere. Most of the time it's from books. So if you could give a recommendation on your favorite business/real estate book and your favorite non-business related book, what are those recommendations?
That is a good question. I would say that I would recommend to find, and I'm going to take this a different way if you don't mind, Dave, but
no worries.
I would recommend finding a mentor within the space who can teach you from real life experience, because at least in my life, I've always found that the practical application through text and the real life actual application of how work actually gets done are oftentimes very different. And so to the extent that you can find somebody who's done this and learn from them and see real world examples, I'm of the belief that will benefit you infinitely more than anything that you'll find in text. So not to keep harping on networking, but I think that's a great place. In terms of just other literature, I love Malcolm Gladwell.
Nice. Yep.
I think that
you got a favorite?
Blink would be right up there, just because I think in the world of investing, trust your gut. You can underwrite and look at numbers and look at market comps until you're blue in the face. But if you listen to what your intuition tells you, most of the time that gut reaction will be correct.
Absolutely. I love it. And no, I like that you said mentor. I think you're going to get more from a mentor by far than you will from any book you pick up. I do think you can get a lot of great things from books, but there's nothing that compares to a good mentor.
I love reading. I don't mean to downplay it. I just think that if you're looking to get started in the business, start with real world experience. Absolutely.
All right. So then last question. You've given us a ton of wisdom so far regarding real estate, but you need to receive as well. So if someone were to bring you something, being it a lead, a contact, a book recommendation, anything, what would you like to receive?
Any and everything. I mean, our world and our portfolio is built on not being closed-minded to anything that comes in. So if you've got a lead, you've got an idea, you want a joint venture partner, you've got a book that you really liked and learned something valuable, I'd love to see all of it. One of the things that I enjoy most about this line of business is just the unquenchable thirst for intellectual pursuit. And so to the extent that I can extend the network, help you in whatever you're doing, if you want to throw an idea and just bounce it off of someone in a different market or who has maybe experience in a product type that you don't, happy to be a resource to anyone who's listening or that can benefit from what we're doing here, Gabe.
Awesome. And on that note, if somebody did want to get in contact with you, what's the best way for them to reach out?
Sure. Best way to reach out is through email or through LinkedIn. LinkedIn is Jordan Linkow, JORDANLINKOW. Or you can reach me via email at jlinkow, first initial, last name, JLINKOW, at nectarequities.com. That's NECTAR, equities plural.com.
Perfect. So there you go. If you want to get in contact with Jordy, jlinkow at nectarequities.com. I will also put the link to his LinkedIn profile page in the show notes, so you can jump in there, click through, and reach out to Jordy. Again, Jordy, thank you for coming on. I've appreciated your conversation. For everybody who's here watching the show with us, thank you very, very much for coming along on the journey. We appreciate having you here. And again, the best way to support the show is just to subscribe, like, and share with your friends and family. We look forward to having you guys on the next episode.
Sounds great. Thanks so much for having me, Gabe.
Thank you for joining us for another episode of the Real Estate Investing Club. I hope you guys enjoyed the episode as much as I enjoyed putting it on, and we're able to pull some actionable advice that you can apply in your own investing today in the field. Before you go, we have a gift for you. If you're a new investor looking to get started or an established investor looking to take your investing to the next level, I've created an ebook just for you, available on our website. This ebook will cover how I was able to create both active and passive income in real estate with very little money to start with. In it, I will address the 3 most often cited obstacles new and veteran investors run into by showing you how to find deals that are actually deals, how to finance a deal with little to no money down, and how to exit those deals for maximum value. And if you get the ebook today, I am throwing in a bundle of bonuses, 7 of them to be exact. The first one will be the off-market lead generation blueprint, which will take you through the exact systems and processes we use to generate off-market leads like clockwork, which is the most important skill when it comes to creating wealth in real estate. The second bonus is the A to Z REI systems and vendors guide, which will allow you to peek under the hood of our business and see the exact tools, systems, and even the vendors we use to see the success that we do. And the third bonus is the top 100 best performing keywords pack, which will give you the exact keywords we use to target motivated sellers online using PPC ads. The fourth bonus is our contracts bundle for wholesaling and renting real estate, which will give you access to all the contracts we use in the field to execute all different types of transactions. After that is the Investors Quick Analysis Calculator and Offer Tool, which will allow you to quickly calculate whether a deal is an actual deal and will allow you to create an offer automatically from those calculations. This is a lot of bonuses that I said. I'm just going to keep going down the list. Number 6 is the Investors Daily Success Tracker, which is a tracker you can use to ensure you are taking the right actions day in and day out to reach your financial goals in real estate. And the last bonus is the Wholesalers Template for Quick Assignment Cash, which will give you the templates we use to present our wholesale deals professionally and efficiently to our buyers. Whew, that is a bundle. So it's a mouthful. You get all of those bonuses for free when you download the ebook. All we charge is the admin cost to run the show. So if you're interested in the ebook and the bonus bundle, head on over to the website at therealestateinvestingclub.com. Click on Get the ebook bundle at the top of the page to take advantage of that deal. And with that said, I hope you have a fantastic day, an even better week. Keep rocking real estate, and I look forward to seeing you on the next episode.